Hi, in this video I'm going to discuss how to prepare cash flow statement by direct method. I have already created a video on how to prepare cash flow from indirect method. If you're interested, you can watch this video. So guys, cash flow statement can be prepared by using two different methods, direct, indirect. Hi, I'm the commerce specialist. Welcome to my channel where you'll find videos covering learning outcomes of various academic qualifications and professional certifications, including life-changing business ideas and hacks. So let's talk about preparing cash flow statement by direct method. The only difference between preparing a cash flow from direct or indirect method is how we calculate cash flow from operating activities. As you know, when we're preparing cash flows as per IAS 7, we have to classify cash flow as per operating, investing and financing activity. So the only difference between direct and indirect method is how we calculate cash flow from operating activities. Investing and financing, both under direct and indirect, is the same. So I've created a question over here. I would like you to be familiar with whatever details are given in the question. You take a screenshot of the question so that you understand. Okay. So the question is here. Just have a look at it. And for your understanding, just in case you don't understand my beautiful handwriting, I'm going to read this for you. Sales 550,000, less cost of goods sold 280. You got gross profit of 270, less depreciation expense 20,000, operating expense 100,000, loss on sale of equipment 5,000, interest expense 12, tax expense 50,000, and you got net profit of 83,000. Then your comparative statement of financial position is given to you. Cash in 2023 is 10 and 2024 is 22. Account receivable in 2023 is 50 and 2025 is 55. Prepaid expense, account receivable is 2023 is 50 and in 2024 is 55. Prepaid expense in 2023 is 7,000 and in the next year is 5. Equipment at net book value 205,000 and 220,000 respectively. Coming to the equity section, we have accounts payable 35 and 40,000, interest payable 3,000 in 2023, 2,000 in 2024, income tax payable 10,000 and 8,000, notes payable 50 and 30, share capital 120 and 50, retained earnings 79 and 102,000. Additional notes are given here. Please have a look at this. New equipment was purchased for cash. Number 2, dividend of 60,000 was paid during the year. Number 3, equipment costing 15,000 having an accumulated depreciation of 5,000 was sold for cash 5,000. And we are asked to prepare statement of cash flow using direct method. So let's begin. Very first thing you're going to do is write cash flow from operating activities. Now, when you write cash flow from operating activities, the very first thing you need to find out is cash received from customers. So I'm writing like the working number 1 because it's not given, we have to find out. So I am making working number 1 here. Okay, I'm trying to find out cash received from customers. So for that purpose, I'm going to prepare account receivable T account. Now when we are preparing account receivable T account, remember account receivable is an asset. All assets have opening balance on the debit side and closing balance on the credit side. The same I have already taught in my video on incomplete records, single entry. Have a look at this video. It's single entry, incomplete records, mixed single entry you can also call it, where I have explained how through making a T account of account receivable you can calculate cash collection. I am explaining it here again. So account receivable, if you notice, we have account receivable here. 2023, 50,000 is considered to be the opening balance. The current year is 2024, 55 is considered closing balance. So I'm putting opening balance here being an asset. So balance brought forward. Account receivable 50,000 is the opening balance. And carried down closing balance is 55,000. After this, look at sales. If nothing is said, that means it's credit sales. When you sell on credit, the entry is account receivable debit, sales credit. So your sales is coming here, which is 550,000. You add these two, this will become 600,000. This will also be 600,000. So 600 minus 550, you will get cash collected from customers 545,000. This is how you understand the T account. Opening balance of receivable was 50,000. Then you made additional sales on credit. Total amount you had to receive from customers is 600,000, out of which they paid you 545 and the closing balance is 55. So we got the first amount, cash received from customers, which is 545,000. The next thing we need is cash paid to suppliers. We need to calculate this. Cash paid to suppliers. Working number 2. For cash paid to suppliers, I'm doing working number 2. I'll be making 2 T accounts. First, I'll make a T account of stock just to find out what was the amount of purchases. So if you look at this, while copying the question, I forgot inventory, I've put them here. So if you look at this, we have opening inventory 25 and closing 30. So I'm putting this here. Stock is an asset. Obviously, opening balance should be on the debit side, 25,000. And closing balance should be on the credit side, which is 30,000. Now, when you're preparing a stock account, have a look at cost of goods sold, 280. Cost of goods sold always goes on the credit side because this is the stock which have been sold, 280,000. So when you add these two, this will become 310. This will also be 310. So from 310, when you minus 25, you get the amount of purchases, which comes to 285,000. So if you want to understand what I've done here is, see, opening stock was 25,000, then we purchased additional stock for 285, total stock I have was 310, out of which stock which got sold, which is cost of goods sold, is 280, and the remaining is left as closing stock, which is 30,000. So this working is not over, we just found purchases. We want cash paid to suppliers. For that reason, I have made one more account, which is called accounts payable. Okay, so a T account for accounts payable. Accounts payable being a liability, we have opening balance and closing balance. All liabilities have opening balance on the credit side. So I have brought forward how much? Accounts payable is 35,000. As per question, closing balance of accounts payable is 40,000. And obviously when we purchase, the entry is purchases debit, accounts payable credit. So I'm going to write purchases here, 285,000. Now 285 and 35 when you add, you get 320,000. So you would have 320 here as well. Now 320 minus 40, you will get the amount of cash paid to supplier. Cash paid to supplier. 320 minus 40 will give you 280,000. So that is what you write here. Cash paid to supplier is 280,000. And obviously if it is cash paid to supplier, it should be in negative. The next thing under direct method you need is cash paid for operating expenses. Now for cash paid for operating expenses, the idea is pretty simple. So if you look at here, we have operating expenses of 100,000. Okay, so you can simply take this like this, 100,000. Okay, this is working number 3. And you have a prepaid here, closing prepaid. Okay, generally we minus closing prepaid to get the expense for the year. But here we are trying to calculate cash balance. So you add the closing prepaid and minus the opening, which is 7,000. So you will get cash paid for operating expenses as 98,000. Generally what we do is, if we have an expense for the year, we add opening prepaid and minus closing prepaid to work out, expense for the year. Okay, but here we are trying to calculate cash paid. That's why I did the other way around. If you still a little confused about it, watch my video on accruals and prepayments. You will understand what I'm talking about. Okay, so now let's get back to the other expense. We are done with cash received from customers, 545, cash paid to supplier. I did two working, first to calculate stock. Through stock account, we calculated purchases. Through accounts payable, we calculated how much cash has been paid to suppliers, which is 280. For cash paid for operating expenses, I simply took 100,000, added closing prepaid and minus opening prepaid expenses. So I got cash paid. Next is cash paid for interest, or you can say interest paid in cash. That would be your working number 4. So I am putting here working number 4. 3 I did here only, okay? This is 3. So I'm making a T account of interest payable. Interest payable is a liability. Opening balance is 3,000, closing balance is 2,000. Opening balance of liability comes on the credit side, brought forward 3,000 and carried down, closing balance is 2. And if you look at interest for the year is 12,000. So if 3,000 was payable at the beginning of the year, 3,000, and interest for the year is 12,000, so total how much is payable? 12,000. This is coming from profit and loss. So total interest payable is 15,000, out of which the closing balance is 2. That means the rest has been paid. So you take 15,000 here as well. And 15 minus 2, this much cash has been paid for interest, which is 13,000. So you can take here interest paid in cash, 13,000. Okay, so I'm explaining again. Opening balance of interest payable 3,000, interest for the year 12,000, total interest payable 15,000, paid 13, closing balance 2. So what is paid we take here. Similarly, as we did for interest payable, I'm making a T account for income tax payable as well. How much tax is paid in cash? This is what we're trying to calculate. So next is income tax paid. Okay, working number 5. For that, working number 5, I'm making a T account of income tax payable. Income tax payable is a liability. If you could see here, we have 10,000 as opening balance, 8,000 as closing balance. So brought forward 10,000 payable, carried down 8,000 payable. Okay. Now from profit and loss, if you see, tax is 50,000. So from profit and loss, tax for the year is 50,000. So opening liability was 10, current year liability is 50, total tax payable is 60,000, 60 minus 8, okay, 60,000 minus 8 here, the rest has been paid. So we'd say cash paid, how much? 60 minus 8 is 52,000. So you can take here income tax paid as 52,000. Now that we have done all the required calculations for cash flow from operating activity, which is for your revision purposes, I am repeating again: cash received from customers, cash paid to suppliers, cash paid for operating expenses, interest and taxes paid in cash. So we will add these. Please note we have to give importance to the signs. 545 is a cash inflow without bracket, and these are outflows. So when you add all the outflows and minus from inflow, okay, you should get cash flow from operating activities. It will be 102,000. Next step is cash flow from investing activities. Now here again I would like to remind you, ladies and gentlemen, that when we are preparing statement of cash flow from direct or indirect method, only the way we calculate cash flow from operating activity is different. Here we are doing direct method. This is how we do. In indirect method, as I already told you in the beginning of the video, I have created a video where I have covered indirect method in detail. So you can watch that and you will know how indirect method differs from direct method. So when we come to cash flow for investing and financing activities, there is no difference in the way it is made in direct or indirect method. So let's look at investing activities now. First of all, we have to look at sale and purchase of non-current asset. We have equipment given here as net book value. Okay, so I will make a T account here, working number 6. We are trying to calculate purchase of equipment, and please note we are given net book value. So opening balance of equipment is given to us 205,000. Obviously it's an asset. Brought down balance will be on the debit side, 205,000. Closing balance is given to us as 220. Now it tells us equipment costing 15,000, having an accumulated depreciation of 5. So 15 minus 5, the net book value will be 10,000. And it was sold. So if it is sold, I'm going to put this as here as disposal. Disposal. How much? With net book value. I have the net book value. Cost minus accumulated depreciation, 15 minus 5. So I'm putting the disposal as 10,000. Likewise, there is depreciation. So depreciation also goes in the net book value T account. Depreciation for the year, okay, which is 20,000. So this is 220, 240, 250. This should also be 250. 250 minus this. So equipment was purchased for 45,000. This is purchase of new equipment. So this is what it says here in note number 1. New equipment was purchased for cash. How much? 45,000. So you can put that here. Purchase of equipment as per working number 6. It is 45,000 in brackets because it's a purchase of equipment. Now if you'll notice in the question it says equipment costing 15,000 having a accumulated 5 was sold for 5,000. So you are getting money from selling the equipment. So I'm calling it sale proceeds. Sale proceeds of equipment 5,000. So there is only one non-current asset, the rest are current assets. So just net it off. You will get cash flow from investing activities. Cash flow from investing activities. 45 minus 5, you will get negative 40,000. The next step is to calculate cash flow from financing activities. The very first thing when you look at financing activities, look at share capital or common stock. It's 120 here and 150. So if it is increasing over the years, that means you're issuing more shares. You can write here issue of shares, okay, from 120,000 to 150. Whenever you are selling more shares, money is coming in, and that's a cash inflow, 30,000. Likewise, the next thing you look at is the long-term liability, notes payable. From 50, it's becoming 30. That means we are paying the notes. That's why the liability is decreasing. So we can say payment of notes, payments of notes. From 50, it became 30,000. That means we have paid 20,000. Finally, when you are doing your financing activities, don't forget dividends. How much dividends you have paid? 60,000. So I can say payment of dividend, payment of dividends in negative 60,000. Now if you notice, this is 60 negative and 20 negative, outflow, cash outflow. This is 80. 80 minus 30, you will get net cash flow or cash flow from financing activity. 80 minus 30, you get 50,000, and that would be negative sign of the greater number. Once this is done, you have cash flow from operating activities, from investing and financing. Add all of them, keeping in mind the signs, plus and minus signs, negative and positive signs. You will get net cash flow. Okay, or you can call it increase or decrease in cash. So this is 50, this is 40, this is 90. 90 minus 102 will give you 12,000. You can also call it alternatively increase in cash. Ladies and gentlemen, the moment you arrive at this part, that is, you have cash flow from operating activities, investing activities, financing activities, you added all of them, looking at the positive and negative signs. These are two cash outflows. This is inflow. Inflow is 102, outflow is just 90. So when you minus, you get increase in cash 12,000. At this stage, you can check whether whatever you have done so far is correct or not. You can check your final answer as well. What to do is, with this net cash flow, look at the opening balance of cash. How much is the opening balance of cash? 2023, opening balance of cash is 10,000. So you say add opening balance of cash and cash equivalents, which is 10. When you add 10,000 to this will become 22, and this is called closing balance of cash and cash equivalents, and this should be equal to the closing balance. Can you see the closing balance here? I'm highlighting this here. 2024 cash balance, cash balance is 22, and the closing balance should come to 22, which means if your net cash flow is calculated correctly, with this net cash flow, whenever you had opening balance of cash 10, it should be equal to this. Is it? Yes. So guys, this was cash flow statement by direct method. I'm repeating once again, when we're preparing cash flow from indirect method and direct method, yes, you have the three sections: cash flow from operating, investing and financing. But when you compare direct and indirect method, the cash flow from investing and financing remains the same, the working remains the same, but the only difference is the way we work cash flow from operating activities. In indirect method, I'm just giving you a quick review. We don't start with cash received from customers. No, we start off with operating profit, which is EBIT, or profit before interest and tax. After that, we do working capital adjustment. That means decrease in current asset we add, increase in current asset we subtract. Increase in current liabilities we add, decrease in current liabilities we subtract. Then we also add back depreciation, losses, we minus gains, we minus interest and taxes paid. But here, if you notice, there is no depreciation, there is no profit before interest and tax, there is no gains and losses considered here, because it is direct method. Cash flow from investing and financing activity is done the same way, whether it is direct or indirect method. So I hope you have understood. If you have any queries relating to cash flow from direct method, do leave a comment. I will respond to you as always. I would strongly recommend that you watch my video on cash flow from indirect method, so that you'll be able to compare both the workings. Guys, if you're not yet subscribed to my channel, please subscribe my channel, press the bell notification button so that you get my videos on a timely basis. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time. Love you all.